All right, there you have it. A big jumbo hike there, 400 basis points, raising the lending rate to 22.75%. For the first time in 8 months, and we see the CRR at 45%. We're going to be discussing implications of this for the economy. Joining us now is Professor Joseph Nnanna, Chief Economist, Development Bank of Nigeria, joining us from our Abuja studio. Great to have you on the show.
Nice to be here, Letty. How are you doing today?
I'm doing great. But looking at proceedings from yesterday, were you expecting 400 basis points? I know some analysts talked about maybe 200 or 150. Someone even said about 700 basis points, but were you expecting 400?
So essentially, the central bank has hiked rates up to 400 basis points for the obvious reason that they have already communicated. If you recall, the central bank governor had already transparently said that they are going through a monetary strategy phase of inflation targeting, which means that they are going to deploy all their tools to ensure inflation comes down to an appropriate level. I recall the central bank governor may have mentioned 21%, that he plans to see deflation towards the end of the year, in some respect. So regardless of the magnitude of the hike, I sincerely believe that since inflation targeting is the mantra for the central bank and the MPC, the hike was quite expected. 200, 300 was what most analysts assumed it would come out to be, but because we know that the level of inflation in the country at 29.9% is sticky up, core inflation, that's 23.5 thereabout, food inflation 35, that's stubbornly inching upwards. And what goes around these numbers, the endogenous variables as insecurity in the farmland, low production output in terms of the oil production levels, the geopolitical tensions. If you take a look at all these things put together, you can see why the central bank deemed it worthy to hike the rates at that magnitude. Yes, in fact, it is high, and yes, it's probably the highest in central bank and monetary policy committee's history, but notwithstanding, the central bank has already communicated that the name of the game is inflation targeting, and to do so, they will continue to deploy their tools to drive down inflation in the short to medium term. That's the ultimate objective.
And at this point, that means lending rate is really expensive at this point, getting really, really pricey to go to the banks to get a loan at this time. But talk to me, paint a picture of the immediate impact of this and what you see going forward.
Okay, so the immediate impact, the knee-jerk reaction, what we're going to see with the banking system as well as households and micro, small, and medium enterprises is that typically when the monetary policy authorities hike up the rates, especially this magnitude, the commercial banks, the likes, will essentially write to the respective customers to inform them about the new interest rate hike, which would literally be transferred on to current customers. So we can expect the average lending rate to go up at the bare minimum at that magnitude. But my suspicion is that number will probably go to the preferred or best customers, and perhaps other customers who are perceived to be high risk will probably get a much higher rate. So yes, when you inch up the MPC, when the MPC inches up the MPR, what tends to happen there is average lending rates will go up, and you're basically going to sacrifice a degree of economic growth. That's the trade-off we see. When you fight inflation, you hike up rates. When you hike up rates, households, MSMEs will feel the pinch right away because essentially they'll be less likely to get access to credit, or perhaps if they have current credits running, it'll be more expensive for them to conduct businesses and to reinvest. So I suspect that it's going to be a difficult time thereabout for a lot of businesses in the near term. But overall, the objective for the central bank is to bring down inflation. And if price stability is the name of the game, and I think they've done a considerably good job to signal to the markets that, hey, look, We're here to drive down inflation.
And when do you see the impact of this 400 basis point hike? When do you feel the economy will start to feel the impact of this and maybe some kind of reaction to inflation?
So I think the knee-jerk impact would be, as I've earlier mentioned, banks will probably begin to write to their customers, transferring that interest rate hike to their respective running loans. So I expect that to happen almost automatically. But in the near term, I also expect that there will be a drag on economic growth. If you remember this, the central bank governor said one thing yesterday that stuck out to me, that the IMF has said growth is going to be around a 3% growth. The central bank has said it's going to be around 3.3% growth. The federal government said it's going to be around 3.8% growth. So they're essentially bringing down the projections because they know the magnitude of the hikes that's going to cause a drag on economic growth. So I think by and large, in the medium term, in the short run, we will see a sluggish economic environment because of the capital will be less deployed. But overall, like I said earlier, if the name of the game is to bring down inflation, the monetary policy authorities have done the right thing.
And I'm wondering if we're going to see some kind of reduction, in inflation rate going forward with this, or maybe we need a combination of more 400 basis points coming before we can see it impact inflation. But talk to me about the cash reserve ratio at 45%. Paint a picture of the expected impact of this.
So the cash reserve ratio, or the CRR, debits to banks, which is now at 45%. The previous figure was 32.5, thereabout. I expect if commercial banks aren't screaming right now to the high heavens that this is too much, it implies that it might not be too much. But I sincerely believe, though, that 45% is a way to showcase that there is excess liquidity in the system. And if there's excess liquidity in the system, then that's a way to sequester these funds to ensure that they're pulling out the liquidity to remove the inflationary pressure that the liquidity or the money supply has caused over time. I saw a Nairametrics publication where it showed the money supply 3 jumping all the way to 70-something trillion naira from last year's 50-something December's numbers. So if we're saying that money supply, or M3, is very high, then the central bank will essentially do whatever it takes to bring it back to manageable levels. But regrettably, the central bank alone cannot solve the problem. That's why the central bank pointed out clearly that it takes the fiscal side as well to coordinate their affairs with the monetary side. Consequently, I feel as though when you look at the level of liquidity coming in from the fiscal side, the monetary side will have to now work closely with the fiscal side to ensure they mop up any remnants, if you will, of liquidity that they deem to be excess. That is why I suspect 45% was the sweet spot. But it is the maintenance period of the money, the CRR, that I want to actually figure out. Because the maintenance period could be a couple of days to a couple of weeks and so on. That will essentially let us know the efficacy or how well the CRR and the monetary tool raised to from 32.5 to 45% is actually effective. So that's what we have to watch over time. But to be sure, the CRR is hiked really, this is a significant jump, but as I've earlier said, the price stability is the name of the game. And if that's the case, then we should expect that the inflation level should come down, and we should get some level of equilibrium in terms of money supply of what the central bank will like to see going forward.
Right, and before now, we've heard complaints about customers not able to get enough cash, when they go to the banks or the ATMs, and having to resort to POS operators to get money. So I'm wondering, with this 45% hike there for CRR, that means customers might not be able to find cash at all, when they go to the banks at this time, because I know that's supposed to impact more of credit, but it seems it might also impact getting cash.
Well, perhaps, but I look at it from the lens of we're supposed to be pivoting towards a cashless policy, a cashless society, so we should be using less cash, as it were. So in my estimation, a lot of folks these days have OPay accounts or have money point accounts and what have you. So I suspect that even though the CRR may have been hiked, in the end, there will still be cash available for the customers who require cash. But beyond the cash requirement, I would suspect that the idea here is to be using more of your debit cards and payment systems to conduct transactions. That way we can actually increase the financial inclusion levels and so on.
Yeah, and I hope they can also update those platforms so we don't have network issues and we can just transfer money and actually it goes immediately when you're using some of these apps going forward. But we know the governor reiterated the stance of the CBN on interventions. Interventions are gone, at this point. What's your take on this?
I think that's a welcome news. That's good. Because the central bank historically has been an operator with intervention funds as well as a regulator. And that poses a challenge to their mandate of price stability, because once you do that, it creates a degree of price distortion. Consequently, the central bank governor pointing out that they're out of the intervention fund environment is ultimately a good thing. Let the operators, the DFIs, the commercial banks, the microfinance banks, the finance houses and the likes, let them do the intermediation, let them create the risk assets, let them create the loans and so on and so forth. And the CBN can reposition themselves as a fulcrum for price stability and essentially a banker of last resort to the federal government.
All right, and definitely the central bank governor did say inflation will remain high, as high inflation remains sticky for a while, but at some point we'll see it come down. What can be done for some kind of short-term relief?
Well, short-term relief can be done on the fiscal side, because the monetary side has done their bit by hiking up rates and by increasing the CRR and, of course, adjusting the asymmetric corridor. So that has been trashed out. Now, what needs to occur right now is on the fiscal side for food inflation particularly, because food inflation seems to be the sticky point here. It continues to inch upwards, and that's because of the price of goods and the exchange rate, and more importantly, the geopolitical tensions. So if you take a look at the MBS report, the number 1 and 2 items that sticks out is bread and cereal. And these two components have been alarmingly high in the past few months. So in my mind, what needs to occur is the federal government should support the system broadly by perhaps releasing the strategic reserves of grain. That's on the one hand. And on the other hand, if there's still the heightened level of insecurity in the farmlands, then the tools should be deployed to mitigate the risk of crops being destroyed and farmers being too scared to go back to their farmlands and so on. So those are the 1 and 2 examples I can give in terms of immediate remediations to cure inflationary pressures, especially when it comes to food.
All right, definitely let the farmers go back to the farm at this point. Thank you so much. Great having your perspective. Professor Joseph Nnanna, Chief Economist, Development Bank of Nigeria. Thank you.
Thank you for having me.
All right, after the break, we head to the markets. Just stay with us.